Good morning. My name is Adishan Naidu, and I'm from the Global Markets Retail Investment Team. I'm joined once again with Tom Gale, Executive Global Markets Trading, Standard Bank. This is the Market Pulse. It's the 8th of June. How are you doing, Tom?
Yes, good. Thanks, Adi, and Balesa also with us. Yeah, it's a rocky time for equities, but otherwise I'm good.
Yes, our lovely lady is back. Hi, good morning, Pali.
Morning, gents. How's everyone?
We're good. We're good. I mean, there's a lot to talk about. I just want to start off on a positive note. It's 3 days till the World Cup kicks off. Standard Bank being one of the major sponsors to Bafana. So it's exciting times for us. And then Tom starts off with the doom and gloom. So yeah, this looks like a ticking time bomb here. Tom, want to give us some context?
Yes, well, I hope those of us who are going to stay up till 9 o'clock on Thursday, some of us a little bit advanced in their years, would say that's a late night. So I hope that Bafana puts on a performance. We are going to bring it back to business. There are many ways to monitor the passage or absence of passage of tankers and ships through the Strait of Hormuz. This website is one of them that I use, and it tells us that the strait has been closed for 96 days. I think the conflicts run a little bit longer than that. But,
yeah, I mean, the conflict things, there's some articles about 100 days here and there, so it's been a while, but you know, our market shows that in where it's come off from its highs to now. So yeah, I think you're about right.
Yeah, so we have certainly got through the anniversary of 100 days of conflict, and that stands in total contrast to the promises at the time that this would be a quick operation. The White House had been at pains to say in the early days that it would last just a few weeks, maybe 3 or 4 weeks, and of course we're more than 3 months in. This represents a problem, as we've discussed in many editions of the Pulse, Adi, for Donald Trump as well as for the Republican Party, and of course, you know, for the sad reality that is conflict on the ground. Donald Trump and the Republican Party at the moment is heading for a poor showing at the midterm elections, which come up in November. And I think we can see from the increasingly desperate language from Donald Trump's tweets, who not less than 20 minutes ago actually talked about, implored both sides, Israel and Iran, to stop shooting at each other, because Donald Trump, needs the deal, and he needs it more than Benjamin Netanyahu and the Israeli campaign, which of course is looking to wipe out Hezbollah in Lebanon. Well, that's a sticking point to the Iranians, who insist on a wider ceasefire to bring about a broader deal and reopen the strait. Having said all this, and again we spoke to this, I think, last time around. I actually just illustrating how well the U.S. stock markets have performed nonetheless. And the chart on the left here shows the Nasdaq index, and well, I mean, we can see that Nasdaq has gone up 2.5 times since 2022, and has saved some of its best performance for the last few weeks this year during conflict. Anyone who is enjoying this paper run, particularly if it's your own corporation and you have some intense capex needs, would be very tempted then to use this opportunity to raise capital, to sell down equity at some lofty valuations and raise capital to fund that capex, which is typically to roll out AI-related data centers and so on. So what we're seeing in the US over the last few hours and days is a whole raft of paper coming to market. And in fact, a quick count would show that there's something like $500 billion worth of paper across, well, not least Google parent Alphabet raised $85 billion, and the chart on the right is that. So Google is $85 billion of the nearly $500 billion worth of paper that's coming to market. I think, Adi, you can probably name some of the others. It's very well known.
Yeah, I mean, one of the biggest well-known one that coming to market, and I mean, it's on the lips of most of South Africans trying to understand how they could buy into it, is SpaceX. So, I mean, that's going to be a big one coming to market. It's going to be available on our platforms on Friday. Unfortunately, we don't, and given the fact that it's a US IPO, we don't have the ability to participate as South Africans in our platforms, but we will have the opportunity to buy it when it lists. So it will be available on Shift, and those are familiar with WebTrader, that's now in Shift. It'll be on the website, also Shift platform. So it'll be part of Investor as well as Trader. The ticker, if I'm not mistaken, they're looking at a ticker. I think it's SPCX, which is the ticker. So it's going to be an interesting one. Another one that's also on the talk for gamers out there listening, which is where papers coming to market, and I mean there could be value in, is Take-Two. Which is call it a tech company, but more specializing in games or electronic games. And a big one, why that's a big one, is they are the founder of GTA 6, so Grand Theft Auto 6, where that's been almost $1 billion spent. One of the most for a video game development. It's taken them about 8 years. So big talk on town on that. So that's a lot happening in the US space.
Yes, and I've broadly gathered this together under the heading, as I say here, of tech and AI and new industries. And SpaceX is, of course, a very capital-heavy business model, launching rockets and colonizing the moon. But the broader theme, and away from gaming, of course, is the need for AI technology to build data centers and the power generation that relates to that. It therefore does illustrate some of the turbulence in markets right now. In particular, on Friday, Nasdaq had a tough time. These are typically all Nasdaq listings which are being brought to market, and so I think it's fair to assume then that those institutions who might be getting ready to buy into this paper, most of it primary, some of it secondary, would need to sell a little bit of their current holdings. And in fact, SpaceX, I think I'm right in saying, has reserved about a quarter of its book for sales direct to US retail investors and traders, and they too will likely need to sell down to raise the money needed. And they might be doing some of that in, who knows, in their Bitcoin holdings, which would partly explain the Bitcoin weakness recently. I think another benchmark, a sense, some context here, Adi, as to why this should rattle markets. The New York Stock Exchange turns over $70 to $80 billion a day. So when you have the prospect of some $500 billion worth of paper and capital raise coming, it will create a bit of indigestion. That is significant amount of paper for a market that is liquid, the most liquid in the world, but nonetheless will need to digest all of this. I think the other point worth making here is that the US market is starting to more aggressively price the prospect of rate hikes. Now, this has caused a bit of to and fro. Adi, you and I have talked about this a number of times over the last 12 or so months, and recently more so. I think you'll recall, Adi, that it wasn't so long ago that we were pricing the possibility of rate cuts for the US.
Yeah, so exactly right. We were pricing rate cuts, and it all looks great. And then it's just, as I said, I think we spoke about it about 2 or 3 pulses ago, and I asked, are there more on the horizon? And the graph does show that they are, and that can only mean good for the dollar. I mean, the fact that you want to hold more in dollar and get an interest yield as a retail client, I can't see. There's obviously a bigger financial impact. So.
Yes, well, we'll get to the dollar in just a moment. What I want to just deal with first of all here on the slide, on the chart on the left, is US payrolls that have proven to be rather resilient in the last couple of months. Now, if we just zoom back, the narrative, of course, and you can see it clearly on the chart on the left, is that the US economy has been adding fewer jobs over the last 3 or 4 years, and we even shed jobs on a couple, 2 or 3 occasions over the last 6 months. But actually, and we actually were reminded of this on Friday around the latest release of US payrolls. They've proven to be quite resilient, even in the face of AI-related job cuts. And if the US economy is proving this resilient, adding jobs, that is, at the same time that prices have risen because of the conflict, this starts to build a case for rate hikes. And the graphic on the right here is showing what the US rates market is pricing in terms of expectations. So we don't need to get into the science behind all of this, but what I've highlighted with the yellow circle here is the implied rates move. And you can see that by the December Fed meeting, December 2026, the US rates market is now pricing a hike of just over a third, or just under a third of a percent. And that would represent 125 basis points hike plus a little bit more. So you could interpret this as the market starting to believe that there is a chance, there is a probability of an outside probability of 2 rate hikes before the end of the year.
I don't want to jump the gun here, Tom, and I don't want to come in a bit prematurely. But you've always shown, and I mean, it's no great kind of surprise, but there's a correlation in terms of when the US Treasuries do this and there are rate hikes, that majority of the world's economies follow. And I don't want to jump the gun, but maybe you could give context. But do we see that happening for South African citizens? I mean, for our own rates?
Yes. Well, it's certainly true that the US economy and the US central bank are the biggest and most important in the world, and so there is, of course, an impact. We'll come on to that in just a moment. At the moment, the purpose here is to illustrate what markets have progressed over the last 48 hours or so. I would just caution that rates markets, these are effectively traders' bets, and they can be fickle and they will change with data. The Fed themselves will tend to be less fickle, and of course, the Fed meets in a couple of weeks' time. In fact, I should say in 9 days' time, so later next week, and we will get a chance to hear from the new chair of the Fed, Kevin Warsh, for the first time. But let's continue with the theme of just illustrating what is going on. Gold will typically struggle. We've talked about this in past editions of The Pulse. Gold will struggle when US rates are creating a headwind. And of course, platinum will be punished, therefore, for its gold correlation. So from left to right in these graphics, far left, I've got the gold price in blue, the blue line, coming under some pressure, dropping below $4,300 an ounce today. And it's being dragged lower by the white line. And the white line is the US Treasury yield, but inverted. So the higher the US 2-year yield goes, the lower the gold price comes. And we've talked about gold being a zero yielding asset in the past. And therefore, you see, if you're getting a higher yield from US Treasuries against your zero yielding gold, that does tend to suck a little bit of the momentum out of gold.
But then the middle momentum coming out, you've mentioned, as you said in previous pulses, that gold, our analyst had gold at about $6,000 an ounce by in 2027. Is that still on the cards, given what you're highlighting here?
Yeah, you're right to pull me up on this. Maybe we can come back to that in just a second. The chart in the middle just shows that there's a fairly good correlation between gold and platinum. And we've broken some levels on platinum. And maybe we'll deal with your question as it pertains to platinum too, where our analyst has been very constructive.
Yes.
The chart on the right is just platinum, and it has the yellow line as a 200-day moving average. So we are breaking down on the chart for platinum, which is of course of concern, and it does run contrary to our very constructive underlying fundamental view, which is driven by demand and supply drivers. Okay, so you're right to pull me up on gold. We have been constructive for a while, and we have been talking about the prospect of $6,000 by 2027. We see no reason to change that right now, except that if there is an aggressive hiking cycle from the US, then that will dampen the appeal of gold to those investors who would instead then rather have their money parked in US treasuries for its yield. We do argue that gold is not just about that, that actually gold has done very well through debasement of the US dollar and US and the US more broadly. Gold reserve accumulation has been a big driving force behind gold price performance, and we would consider that will continue. But it is certainly also true that in the short term, we have noted some central banks are having to sell or at least use their gold holdings to finance the raising of dollars to buy energy, which of course is commanding a higher price. Platinum, we have similarly been very constructive, and we remain very constructive on the outlook, mostly on the demand side because of Chinese demand for catalytic converters for combustion engines in those automobiles that they are producing. Now, you and your audience may well just argue that with a higher oil price and higher fuel costs at the pump, that maybe the world will sell fewer combustion engines and more of the electric vehicles that don't require fuel to run. And that may be true. Our analyst did, however, model a 10%, or he stress tested his views with a 10% drop in global auto sales, and still came out constructive on Chinese auto demand. So we would see a reason to stay constructive on platinum group metals, and further to that, our analyst cites the demand that will come through for platinum to go into the catalytic converters for diesel turbines that will power the data centers, and ruthenium all the way through to ruthenium for the hard drives and the chipboards that are required for the AI revolution. So there's almost certainly a buying opportunity here for the platinum group metals if you're willing to deal with the volatility and the uncertainty in the short term. Not only is gold and platinum group metals important for the South African stock market, but they're also, as we've discussed here before, important for dollar receipts for this country. And so the question is, if gold and platinum are struggling as they are, can coal do some of the heavy lifting for our dollar receipts? And the answer in part is yes, coal can do that. In fact, coal prices have done quite well since the onset of conflict as an alternative to natural gas and so on. And then more recently, some supply interruptions globally, not least in China and other parts of the world. And that has lifted Newcastle benchmarks for thermal coal up to $150 a ton. Richards Bay, which is the blue line on the graphic on the left, has been trading above $120 a ton, which is good news for the coal producers in South Africa. But the chart on the right, the graphic on the right here in this slide, actually just goes to show how important oil is for South African terms of trade. And I have inverted the line on the left, which is the oil price, just to show how it does weigh on South African terms of trade more recently, mostly since the onset of the conflict. So more than anything right now, to lift South African terms of trade, a sell-off, a continued slide in the oil price would be very helpful. And I think that is the general direction of travel here. And in fact, if Trump does get his way in the Strait of Hormuz and in the Middle East more broadly, we will continue to see oil pull back, probably to about $88 in the short term. So I think one simple conclusion here at this point in time, or at least something just to remind you and your viewers and your audience, Adi, is that the dollar rand is not going back to the bad old days. Let's not abandon everything that we've learned over the last few years. And the chart here is a simple chart of the dollar rand, and it will remind you and your audience that the rand had a terrible time in 2022, and it had a pretty torrid time through 2023 and into 2024, when of course then we eventually got our government of national unity and things started to calm down. Just to remind your audience, Adi, that in 2022 the South African Treasury allowed institutional investors and pension funds to take more money offshore, up to 45%, and that really opened the gates to rand leaving in favor of the dollar and dollar assets, offshore assets. But that's been done, and with institutions sitting pretty close to their 45% offshore allocation. If anything, they have to sell dollars as dollar rand goes higher. And not only that, but terms of trade has generally been supportive. We're still in a better place despite everything. We're in a better place now for terms of trade than we were 2 or 3 years ago. And it is true that we continue to see sellers, exporters selling dollars and repatriating rands. So the argument here is going to be that for all the chart breakdown that we're seeing in platinum, pressure coming to bear on gold and precious metals, that the dollar rand will not blow, as most South Africans have become accustomed to. This one is now a more steady currency.
So to ask that question, and I mean, without coming across to kind of how do I place it, but I mean, you've given us some context in terms of dollar rand, and then that's brilliant. But I mean, from a trading perspective, because our clients obviously utilize our platforms, would there not be a yield or a kind of trade-off to kind of get more dollars, given the fact that there are interest rate hikes and, as you said, US Treasuries? Would we not see some pressure putting us back to about a 17 mark, or are we still comfortable to say that that based on what's happening, it's more dollar strength rather than rand weakness that'll take us to that point?
Yes, and again, I don't have the crystal ball that would be so useful right now. But what I do want to do is to banish the idea that ours is a wild currency that is drifting blindly. That's not the case. We do rely heavily on dollar receipts from our sales of precious metals. We also rely on the idea that the fiscal backdrop here is sensible. And I would highlight Fitch on Friday, surprisingly, of surprise to our economist, Elna Moorman, upgrading South Africa's credit rating. Now, we're still in non-investment grade, and we have a couple of upgrades to come. In fact, Fitch's upgrade only brought them on par with Moody's and S&P, but maybe you'll recall over the last couple of weeks that both Moody's and S&P are both positive on the outlook for South Africa, as the Reserve Bank continues to target a lower inflation point. That is also positive for the rand. They are adamant that inflation will not pick up beyond the 3% target with 1% leeway. And you ask about the prospect of the US hiking. Just remember that the US hasn't hiked yet. And remember what I said about traders and markets being a little fickle. What we can expect this week is for the European Central Bank to hike rates, but they had been cutting quite aggressively, unlike the Fed, over the course of the last 12 or 18 months. I mean, we may well see Japan hiking next week, just before the Fed meets. But what I do just want to remind you is that the Fed next week won't hike. They won't be hiking next week, Addy. And so when you talk about rates differentials favoring the dollar, it certainly would appear so as implied by Fed fund futures, but we are not there yet. And in fact, we do, broadly speaking, expect most central banks for the next week or 10 days to actually just stay pat. And if the conflict in the Middle East can find some sort of resolution, and there's a big if, and you will have your own views, as will your audience. But if we can find resolution, then the global economy is not yet in the adverse or severe scenario that the IMF had alerted us to shortly after the outbreak. And so I think we need to bear that in mind as well. There are continued tailwinds for the global economy. Typically, and let's not forget that some of Donald Trump's more punishing tariffs have not been allowed to stand on legal grounds. And you ask about the prospects for the dollar. Well, in the short term, it is quite plausible to be bullish on the dollar, but these are tactical trades. And over the last couple of days for markets, the dollar has been climbing the stairs. But this is a rather cautious move. Steve Barrow will continue to argue. And when the dollar resumes its sell-off, it will be down the escalator. So let's just bear that in mind, please.
That's good context. I see you on a very familiar slide. I'm not going to hover on it too long, but this is basically the Digital Plus MSCI World structured note that we actually have on offer for all our retail clients of online share trading, Standard Bank. If you're not a Standard Bank client, but you're using one of another broker, if we have an SLA, we have the ability to obviously offer you this note as well. You just have to check with your service provider. But we did cover this last week, if I'm not mistaken, Tom. We went through it. Just quickly an overview. It is a 37% guaranteed coupon if the market is flat or positive. It is MSCI World, as I said. It is a fully capital protected product. Closing on the 17th of June, so subscriptions need to be in before then. Fully capital guaranteed, minimum investment 25,000. Without taking away any shine from this product, the top 40 capital protected products that you cover as well with Palesa in previous pulses are still on offer, but this is a bespoke, as mentioned before, that is closing next week. So don't want to spend too much time. Check out the pulse from last week. If not, give our contact centers a call at Online Share Trading. They'll be more than happy to chat to you and obviously give you more information if you're interested in this product. But that's it from me, Tom.
And from me, Addy, thank you.
No, thank you so much, Tom. And looking forward to what this week has in store and catching up again with you next week. Have a good one.